Welcome everyone. Thank you. To be honest, we didn't expect so many people to show up. It's summer. We thought you would be on the beach, but thank you for joining us. Let's do a maybe show of hands. Maybe people who are coming here for the first time. It's quite a few. Okay, nice. And how many of you are completely new to investing? Oh wow, quite a few. And how many of the newcomers are, let's say, investing for more than 5 years? Okay, so good mix. So you guys can also support, make this interactive, help other people. This session is for newbies, but anyone can join in. So let's get the disclaimers out of the way so you don't sue us. We are just a community,
Lawyer present.
Say that again?
There's a lawyer present.
I think there are a few lawyers present here. Yes.
You're in trouble.
Yes, I know. You have to be careful. So we don't touch anyone's money. This is a community. We discuss. You decide if you want to invest, not invest. Just learn whatever you want to do. Also, if you want to give back to the community, you could be standing presenting something. It could be a basic idea on a stock or an industry or a financial topic, anything that you want. So we've been going on for a few years now, actually more than 5 years, which is great. We started off in London, and we are doing in a few cities around the world. So our team is based in London, Malta. That's why we are. So we've got quite a lot of members online. So it's a community of people coming up with ideas. We did an event in London last week. You can watch all of those videos on YouTube, and I'll also show you. So this is our website. If you go to cityfalcon.com/meetup, you can also see the presentations from the previous times. And this has a record from 2016. So you can actually go back and see a lot of the old presentations. We're just going to quickly check. Lydia, everything's okay on the streaming?
Just a second.
So we are streaming this on Facebook Live. So we might hit a few technology issues. Maybe we can do another quick vote of hands. Okay, let's do a simple exercise. Can everyone stand up? All right. Yes. So let's say you want to make your money work, right? You want to make a return out of your investment. So anyone who is happy with a 5% investment annually today, so that means if you invest 100 euros and you get 5 euros at the end of the year. Is anyone happy about that? Please sit down. If you're happy with 5 euros on your 100 euros. Okay. What about 10 euros? Okay. A few. Okay, even one of our speakers. So maybe we should change our speaker. Okay. 15%.
We're getting there.
15. Okay. 20. Okay, 25?
Okay.
Wait, where are all the people from Crypto Meetup? You guys all sit down.
Disappear and vanish.
Yes, okay, so 25% is the max return that this group is expecting. Less pressure.
Oh, great.
Yeah,
First everyone's trouble now.
but actually it's not bad. So anyone, how do you decide what is a good return on your investment? Anyone wants to?
The risk.
The risk, okay. Any other factors to consider? Inflation, okay. So what is a good number now? What is inflation for you guys? On your personal, the reported inflation is what the government reports, but what do you see in your daily life with your rent and food and everything else? Is it 10%? More. 15. Okay. So then anyone who sat down before 15%, you're losing money basically in this market. Okay. With that. Yes. But what about long-term views? So if someone, let's say, wants to make, it's 15% now, the inflation, but doesn't mean it's going to be the same for the next 10 years, right? So if you invest now with an objective of getting 10% return over 10 years, 20 years, it's not bad. As long as the inflation doesn't stay that high. Okay. Lydia, how are we doing? I'm running out of points to discuss. Yeah, we're trying to do a few things, so.
Value is good, but the Facebook is.
Facebook's not working? Okay. All right, maybe someone wants to talk about like some investment they did recently. Does anyone own Nvidia stock? Okay, no. Facebook? You have Facebook?
Yeah.
Yeah, you did well last 6 months.
Yeah.
Yes. Any other, like someone bought some stock that has done well? Any AI stocks, artificial intelligence stocks someone's bought? Okay. Anything else? Anyone buying corporate bonds? Okay.
Government bond.
Government bonds, okay. Which ones are you buying, US or?
US and Malta, yeah.
Malta bonds?
Yeah.
Okay, nice.
Let's see.
Yes, I have no idea about Malta bonds, so no clue. Okay, anything else that people are buying? Bitcoin? Anyone buying Bitcoin? It's very cheap, no? $24,000. It's not that expensive, come on. No? Okay, all right. So we are not saying to buy Bitcoin, by the way. We are a group that we don't speculate. We are focused on investing. Okay, Lydia, I'm going to start now. Otherwise.
Okay.
All right. So I think you need to put it back on the screen. No, it's good. Yeah, so before I hand it over to the speakers, just so I run a company called CityFALCON. We support investors to find financial content that they need for making better decisions, whether you're a newbie or a sophisticated investor. And we as a company are more focused on leveraging artificial intelligence to give content. So one of the features we've just launched that you might find it helpful is we've got push notifications and they're completely personalized. What do I mean by personalized? So if you were to use a Yahoo Finance, for example, it will give you alerts saying, hey, Bitcoin just went up or something went down, but everyone gets the same message. What we've built is completely personalized to each one of you. So what you can go and do is you can select out of 50,000 stocks or sectors. So if you're interested in architecture or healthcare or locations, if you want to know everything about Malta. So you just pick your location, your topics you're interested in, and then you can decide how often you want to be alerted. So you can say, give me an alert every 1 hour, Monday to Friday, between this time and this time. So what we do is, for that 1 hour, we pick up all the content from the market, from our 15,000 news sources. We run it through a machine learning model, and it gives you the stories that happen in the last 1 hour. And that's what you get. So whatever period you decide. So you can try it out on our platform. It's called CityFALCON if you want to download the app. So you can do that. So before I hand over to the speakers, just quickly, just to explain a little bit about how are we different from other groups. So do people, and I've done this last time also, but just to kind of explain to the newcomers. So does everyone understand the difference between speculating, trading, and investing? If you don't, just raise your hands. It's okay if you don't.
Perhaps you should shed some light over the basic differences.
Sure. Anyone can start with speculation, maybe an analogy. Gambling. Yes. Anything else? Okay, so sorry.
Next month's weather.
Next month's weather. That's a very good one. Yes. People bet on everything, right? Especially men. Is it going to be sunny later on today? Yes, it's true. Actually, I asked this question to ChatGPT about speculating and give me an analogy. So it said basically it's like playing musical chairs on a Titanic and hope that when the music stops, you have a chair for yourself. So that's speculating. And then you die anyway. Yes. Trading. Anyone wants to explain trading? Say that again. Buying and selling. Okay. What is trading?
Import and export.
But more on the stock markets. Yeah, stock market trading.
Foreign exchange.
Yeah. So it's when you are doing really short-term trading. You're saying, okay, something will move up in the next. Sorry.
Calculated risks.
Calculated risk, if you want, but it's like very short-term kind of moves typically. And this is typically when you look at stock markets, it's based on price movement. So for example, someone is a Bitcoin trader, they say, okay, I will buy at $25,000 because I think it will go to $30,000 and I'll sell it at that point. Or maybe they have some science behind it. So that's trading. And what is investing?
Long-term goals.
Yes, long-term investing. Any analogies? Okay, so I asked ChatGPT again, of course. And so the analogy it gave me is finding a diamond in a waste paper basket. Okay, so finding a diamond in a lot of garbage and a lot of rubbish. So there's a lot going on in the markets, a lot of overvalued companies, and how do you find the companies that you want to invest in? So just to explain, so we are focused on investing. The third one, we are not focused on speculating, not trading. So I put an example online. It's, if you have your daily pastiche budget, and if you want to make it into Ferrari in 20 years, 30 years, the speaker is going to help you do that. Okay. So with that, I want to start off with, I would call her like the Warren Buffett of Malta. So Caroline. Oh no, sorry, we're starting with, sorry, wrong one. So many of you would have seen him in the gym, during daytime, or moving his hips in the nights, if possible. But he's also a great investor. So Sergio, over to you.
Yes. Thanks for the intro.
Yes. I'm going to find your presentation 1 second. You can introduce yourself while I find your presentation.
Sure, no problem. So I'll introduce myself, I guess, while we wait. Cool. I think that's, we need to go back a little bit. A bit more. Yeah, all right. All right. Good evening, everyone. Thanks for coming and listening to me. I'll just start introducing myself. My name is Sergio Vidal. I'm an investor and entrepreneur. I was working at Goldman Sachs. I was an executive director in the investment management division. So I was essentially managing money for pension plans, institutions, and also high net worth individuals. Some of you, of course, you would have heard of them, but I can't really say their names. But it was quite exciting time for me. What I was doing there was selecting funds, basically selecting investments for them. So I'm also Peruvian. I don't really look it, but yes. And the point of this presentation is to kind of try to distill the information or the knowledge that I've gathered, over almost 20 years of investing for people who are absolute beginners, and to really start from the ground up on how to think about investing, and most importantly, how to get started. So if you haven't invested a penny yet in anything other than maybe buying a house or something like that, hopefully this presentation is for you. All right, so I'll go to the next. So the 4 key points of the presentation is, first of all, why invest? Why does it make sense to invest your money where you could just be spending it, right? What can you invest in? Different options that exist out there. What to avoid. Actually, this is very important, actually, even more important than actually investing itself. And then finally, how to start. Okay, first of all, why invest? And before even talking about that, is first of all, what is investing? A lot of people really don't know what investing is. I've heard that word, but really don't know exactly what it means. So when you think about it, investing, it's really the process of changing your money for something else, for an asset, let's say, that's going to give you more money in the future. And that could be by what we call capital gains. So you can sell that asset for more later, or through income generation. So getting a dividend, getting interest, for example. And when I was younger, before I knew much about finance, I thought like that seems a bit counterintuitive, right? So I'm actually giving money to get money. So like, why do I need to do that in the first place, right? That doesn't really make a lot of sense. But the way really investments work is like, you can think about it as like buying a little machine. Like, let's say you can buy an iPhone in the shop, but instead of buying a thing that makes phone calls, you buy a machine that actually is making you money, that prints you money. And the next question is, how much do you pay for a machine that prints money? It really depends. It's like how likely it is to print that money, how likely it is for you to actually be able to sell that little machine later, and how much growth is there going to be there. And actually, that's the whole point of the financial industry. Like it's called valuation. Like trying to value investments and decide, okay, this thing should be worth this much. And I won't go into a lot of detail as to how you do that, but it's got to do with interest rates, for example. When interest rates are low, it means you can borrow money to buy those machines. And when interest rates are high, it becomes more expensive, so people start selling and those become lower in value. So really, investing in general is just a way to make money over the long term. So why should you invest? It's not really something that I think is optional, to be honest, for most people. Like, in the world we live in, there's actually a huge growth in wealth inequality. So meaning that the rich are getting richer. And as you can probably tell, I'm not really a communist or a socialist, but it's really just the way the world is working. It's not really something we can do much about. And that's really driven by it's just a fact that we need to accept and we need to do something about it. So, and it's really driven by a lot of things, and I touch on some of them here, like, technology and automation. We've all heard about ChatGPT, obviously. We're all kind of thinking about how that could affect your ability to make money. So the point really of this is like you want to not compete with ChatGPT because, he's a really difficult adversary, but you actually want to own a bit of ChatGPT. So when you invest in the stock market, you actually become an owner. You're participating in the upside rather than actually fighting against it. So if you own shares in Google, Microsoft, companies like that, you can actually you won't be hopefully left behind, or you can try not to be left behind because of the fact that financialization is happening. Essentially, companies are able to capture a lot of the value creation. And if you don't take part of it, then you might lose out. Globalization, working remotely is the norm almost now. So basically, companies, won't pay a premium, I think, for much longer for people, just because they have a European passport. So you're competing against the whole world. The decline of the welfare state, we've seen the protests in France just a few weeks ago. I wouldn't really rely on the nanny state to look after me personally, to survive when I'm old. Inflation, we talked about it recently, so I won't talk about it again. And then finally, like more on the positive side, is that actually investing can give you financial security and financial freedom, hopefully, if you're successful at it over the long term. So what stops us from investing? And I think that's maybe you can relate to some of these things. Most people think it's hard. Like they see the tickers, or they see people like shouting buy and sell. They think they need to put on a yellow jacket and start like jumping in the trading pit, and that's the way you actually invest. But like the reality is that that's not how it is at all. And that's kind of the good news for tonight. And the reality is that you can actually do it in less than 10 minutes just from your phone right now. And I'll talk about exactly the tools that you can use. If you have Revolut, for example, you can do that. So I'll tell you a little bit about that. Also, we fear losing money, which is completely normal. Of course, I hate losing money. Everyone does. But there's ways to mitigate that risk, and I will talk a lot about that. And then lack of investment options, and thankfully for us in Europe or in Malta, we don't have that problem. We can access, as I say, stocks from our phone, Revolut. But if you live in China, for example, you can't invest in the stock market in the US if you're just a normal person. There's capital controls. The only thing you can do is buy a flat, and that's why China has a huge oversupply of flats that are worth nothing anymore. So it's almost a privilege actually to be here today, to be able to invest, and you should actually take that opportunity if you can. I would recommend. Okay, so hopefully you kind of see some good reasons as to why you should invest. Now let's talk about what can you actually put your money in. And there are different types of investments. They're known as asset classes. So the first one is cash. We all know cash. You know, we can put it in the bank account and get zero and get it destroyed by inflation. So it's not normally a very good long-term strategy, but unfortunately that's what most people do. Then you have bonds. Essentially, it's a contract, a promise from someone or a corporation, a government, that they will pay you a fixed amount of money over a certain amount of time, and they might pay you a coupon as well, or some money during that time period until they give you back all your money. Equity stocks. Again, this is something everyone talks about. Probably the most popular thing people think about when they think about investing. It's just owning a little slice of a company, like let's say Facebook. You become a partner when you buy a stock. You essentially shareholder. You own the right to the profits that company is generating. Then you have real estate. Again, outside of cash, probably the biggest investment that everyone thinks about. We were just talking a second ago about real estate, and it has been a good investment over the last 50 years, but it's not the only investment out there, and in fact, it has some downsides as well, because a lot of people put all their money into this asset class, and it's not really leveraged. So you use borrowed money, and when things go down, you can wipe out all your equity, all the money that you put in, because the loan stays the same, but the value of the house goes down. So it's not a riskless investment as most people tend to think about, because it's been such a good investment for so long. Then you have alternative investments. That's pretty much everything else. You can invest in gold, commodities like oil, stuff like that. Crypto. I don't know if I'm allowed to say that, but some people think it is a good investment. Then you have venture capital. You can invest in a startup. It could even be like your friend's startup, but there's actually venture capital funds you can give them money to, and they can invest it for you. And then finally, you have things like hedge funds. That's a hedgehog, but that's the closest thing I could find to illustrate that. Those things at the bottom are normally not really meant to be a big part of your portfolio, but there are also some of the investments that are available. Right, so long-term investment performance. And this is where it gets interesting. This is 200 years of data. And as I said before, like most people just hold cash, and they think it's the safest. They don't want to lose money, right? So, okay, no one's living for 200 years, but let's say you actually held your dollar 200 years ago, and you held it until now. It'll be worth 5 cents because of inflation. So you wouldn't have made any money. You would have lost a lot of money. If you bought gold in 200 years, it'll be worth $3.20. Not bad, but it's actually quite bad for that long time period. Then if you bought bonds, those bonds would be 1,505. So that's a huge return, right? More than 1,000 times your money. And if you bought stocks, it would be worth almost $1 million. So stocks are probably the riskiest of these asset classes, and you can see how it goes up and down. But over the long term, it's actually it pays to take risk. And by the way, please feel to raise your hand or ask me anything if you have any questions. So what do smart investors do? They invest in a bit of everything, or almost everything. Not necessarily, they don't have to invest in all the alternative options, but most people will invest in at least stocks and bonds. Why would you do that, actually? Why not? You saw that graph before. It's like, okay, I'm just going to buy stocks, right? It's the smartest thing to do because they give so much better returns. But it's not quite straightforward as that. Stocks are very volatile over a short time period. You may actually lose money. And there's also another advantage of diversifying into other types of assets like bonds, is that due to the magic of mathematics, you have when you have assets that are not correlated, meaning that when one goes up, the other one goes down, you can actually get higher returns with the same amount of risk, which is actually like financial alchemy. It seems like, but it's actually just math and common sense. So, okay, we've talked about why we should invest, what we can invest in. Now we want to talk about how much, right? Okay, you're telling me, okay, you should invest in everything, but okay, how much should I put in each thing, right? The answer is it depends. Depends how old you are, depends what your objectives are. But let's take an example here of what we would call a conservative portfolio. And why is it conservative? Okay, so it has 50% bonds, 30% cash, and then 20% equity, stocks. So over 100 years, the average return would have been about 6% per year, which is not too bad, right? When you compare, you're getting zero on your money in the bank. And then in the best 12 months over that 100-year period, that portfolio would have been up 31%. Just on any given, not on one of those periods, right? That's the best 12 months. And then in the worst 12 months, it would have been down almost 20%, which is pretty bad, right? Who wants to see that? But, you shouldn't really be thinking about investing over 12 months, You should be thinking about investing over 40 years normally, at least, if you're thinking about retirement age. Now, if we expand a bit the investment time horizon to 5 years, the best 5 years, you see, it only went up 17.2%, and then in the worst 5 years, it went only down by 0.4%. This is annualized, per year, which is still pretty good for the best 5 years, but it's not that bad for the worst 5 years as well. So you see how the most important concept here is that when you expand your investment time horizon, when you think longer term, the returns become less extreme. So that's how you should think about investing. It's like it's something that you're just going to do for the rest of your life, pretty much. Now let's look at the aggressive growth portfolio. This is something that maybe a younger person will do, and I'll talk about why in the next slide. But you have 85% in stocks, and then nothing in cash, and 15% in bonds. Your average return per year is almost 10%, which is huge. Imagine over 100 years, that's a lot of money, growing almost 10% per year. And in the best 12 months, you will be up more than double your money, in just this one random period. But in the worst of months, you'll be down 60%. So you would have, like on paper, you would have been down more than half your money. So it takes a lot of stomach to bear with that. But then again, you shouldn't be thinking on 12-month time periods. If we expand the time horizon, 5 years, over 5 years, you would have made, in the best 5 years, 32% per year, which is also amazing. And you would have, in the worst 5 years, you would have lost almost 14%, which is pretty bad, actually, But then again, that's a pretty aggressive portfolio. It's not suitable for everyone. And you should think long term. So you can always invest in, I won't go through every number because you get the picture, I'm sure. But you can actually change those allocations to suit your needs. Okay, and how do I know what suits my needs? I can't tell you, I'm not a financial advisor in Malta. So, but what I can tell you is there's a common rule of thumb that you can start your journey with, which is essentially 100 minus your age is what you should put in equities and stocks, and then the rest you can put in bonds. And then you can decide maybe from the equity allocation to put money into alternatives or into real estate or things that are a bit more risky. But you just gotta bear in mind that you should be replacing things that are similar risk. You shouldn't take away all your bonds and put it in crypto. That would be stupid. So does that make sense? Yeah. Okay. The next point is what to avoid. The first one, unfortunately, you can't do much about if you make this mistake, but I'll mention it anyway. So let's take this example. Our friends Chad and Wojak. They invest $100 a month in the 6% per year conservative portfolio. And the only difference is that Chad started 10 years earlier. So he started at 25, and then Wojak started at 35. And then they both retired at 65. Anyone want to guess what's the difference in the value of their portfolio when they retire? like, how much more does chat have? You think 50% more, 20%, 80? Any guess? No?
More than that. 100, yeah, 3 figures.
74.
Very close. It's 100% almost, you know? So why is this? You know, it doesn't really make a lot of sense because, like, you know, you're saying he's invested for 40 years and he's invested for 30, so it's only like 25% difference. So why is 100% difference in the results? It's because it's been compounding in the last 10 years. Like, that money that Chad invested has been compounding and it's already quite big. And so the amount of money that's compounded for those 10 last years makes the whole portfolio be so much bigger. So it's important just to start soon. The next one, it's paying high fees. You've probably heard about this one, but I'll just talk about it in a second. Same investment. Poor Wojak here paid 2% fees and Chad paid nothing. Which in fact is impossible, but you know, let's say he invested in ETFs, which like charge almost nothing. So 100,000, again, the difference between the two investments is almost double as well. So, you know, why is that such a huge difference? You know, you think 2% is nothing, you know, like 2%. Well, basically, in broad terms, the difference is that you're actually compounding at 4% rather than 6%. And over a 25-year time period, that makes a huge difference. So it's important to just pay a lot of attention. If you're actually investing in any fund that your bank manager, normally retail banks are pretty terrible at this. You know, they offer you like funds that, you know, they will promise to outperform the market, but over 25 years, almost none of them do. So what I think Caroline will talk about this in a second, Warren Buffett recommends and people have just to invest in things called ETFs, you know, exchange traded funds that charge almost no fees or very low fees, and you track the performance of the market. They're much better investments for people, generally. The last one is one that most will trip up on. It's you know, being emotional, making mistakes, and you know, I will admit I've made some of these mistakes as well. It's for example, trying to time the market. You know, you see, oh, now like stocks are falling, COVID, all this stuff. Like, I'm not going to put any more money into investing. But in fact, really, that's you should really be agnostic as to what the market is doing, because over the long term, markets tend to trend up. If you try to time the market when you will invest, when things are cheap, let's say, or things are looking down, like you might actually miss the boat, and that's what normally happens to people. Not having a plan, not thinking long term, and not diversifying. You know, I know a lot of people that, you know, they go all in on one thing. You know, they buy like a shit coin or something like this, and they think they're going to be rich. You know, by all means you can do it, but that's not investing. That's basically gambling. So that's a huge mistake people do. So, you know, after 25 years, yeah, Chad wins and Wojak could have done better. Now, another mistake people do, and I'm sorry, like, I don't know if people were hoping to get rich quick from my presentation or learn that, but that's not really how it works. That's why I sat down at 10%. That's actually a pretty good return. So, you know, investing, yes, it can make you rich for sure, but you know, over the long term, and if you're disciplined and invest, and you actually have a good amount to invest. So, like, you know, very famous Charlie Munger and Warren Buffett, you know, they got rich through investing, but they're almost 100 years old. So I don't know if you want to wait that long. And in fact, you know, I would say they didn't really actually get rich from investing. They actually got rich from running a business of investment. The next one is, you know, high-paying career. That's actually a very good way to start. And, you know, learning something like coding, something like that. There's actually a movement, mostly in the US, called FIRE, which stands for Financial Independence, Retire Early. And what they do is they get really good jobs at, you know, tech companies. They work their asses off, you know, until they're in their 30s, and then once they've saved as much as they can, you know, they invest, let's say, $1 million from their salary into an ETF like the S&P 500, and they live off the dividends of that. So, you know, it's not for me really, because like even like 4% from $1 million is only like $40,000, and in the US, you know, you won't get to them for that. But you know, some people are happy doing that, you know, so that's a way to reach financial independence maybe. But not for me. The next one, which I think is the best, is starting a business. That's how most rich people we know and love and hear about became rich. Of course, it has a lot of risk. That's why it pays off so much as well. But this, this is kind of outside of this presentation. But there's also other ways to start a business that don't involve so much risk, like starting a side hustle and stuff like that. There's other ways as well to get rich, of course, like hiring someone rich, picking good parents, I don't know, buying Bitcoin in 2010. Like, I didn't do that. But, that's outside of the scope of presentation. And the last one, and sorry, this is a cheesy one, but I really believe it. Not investing in the most valuable asset. And anyone who wants to guess what's the most valuable asset?
Yourself.
Exactly. Yes, yourself. And that's I think the biggest mistake people make. So the average person in Malta works almost 2,000 hours a year. They spend about 2.5 hours daily on social media. That's actually for the whole world. And I guess you just got to ask yourself, and I'm going to make a show of hands about this, how many hours a day are you actually spending a year on making money for yourself compared to someone else, It's a percentage, let's say, So you're all here today, so, at least it's 1 hour. So, that's actually, I think, the best thing you can do. Like, just really spend time learning, maybe starting a side hustle, something like that, and learning about investing. Now, the last point, how to get started. Timeline. Do your own research. I mean, this is a bit of doing your own research, but there's of course more to it. I can't really cover everything. I think the best thing is, to decide your asset allocation. Think about your circumstances, but be sensible about it as well. The rule of thumb I talked about earlier is actually a really good starting point. Then open an investment account in 10 minutes. You can actually do it on your phone. Like if you have Revolut, you can just open the stock trading option and you can start investing then. And then the last thing is just do it regularly. Don't think it's like, okay, today I'm going to become an investor. I'm going to put all my money and do it and go to heaven. No, like just do it regularly. Set aside 100 euros. In the example we said before, Chad was only investing 100 euros a month. That's 3 euros a day, more or less. And that's like a coffee. It won't really make much of a difference. Just have one less pint at the weekend, and you can do it. So, and then monitor your portfolio. Every year, maybe just make sure that your allocation makes sense for your objectives. As you get older, you want to take less risk because you're depending on this fixed income normally, and of course, you don't want to, lose it all and just have no other way to make money because you're too old. So, just monitor your portfolio. Investment providers, again, just big red disclaimer there. I'm not getting paid by them. I don't recommend that you use any of them. I'm just saying that these people exist. So Revolut I talked about. There's eToro as well. I actually haven't really used it very much. But I hear they're great for beginners as well. But there's also interactive brokers, which I use quite a bit, it's quite a kind of more advanced trading platform. I really wouldn't recommend it for beginners, but if you actually get excited and really learn a lot, that's actually a great place to trade or to invest. And these are available, to people in Malta. Now, sample investment products. I just wanted to get very, very specific because people always also say okay, invest in equity. Okay, that makes sense, but what equity? A lot of people think oh, should I buy Facebook? Should I buy, I don't know, Google, Nvidia, I don't know, GE, Standard Oil? I would say if you're new to investing, forget about picking stocks. You have no business doing that. It's a profession. I think you can do it. I'm not trying to be arrogant that you can't. But I'm saying is to start your core portfolio. It's not sensible to take what's called active risk. It's basically selecting stocks, doing too much of that. So I put a list here of different ETFs. So these are low fee funds that track the different asset classes, and they are very diversified. So they invest in basically everything. So to give you an example, the equity ETF here is the Vanguard FTSE All World UCITS ETF. And when they say all world, it's really all world. Pretty much it's 95% of all the stocks that exist in the world are contained within this ETF. And it's actually in Revolut as well. So the good thing about it is that you're not taking the risk of one single company. You have thousands of companies in this product, in one single product. So it's very unlikely that all these companies will go bankrupt. And if they do, that's probably because there's a nuclear war, and you wouldn't be worried about that.
Sorry, what does ETF stand for?
It means exchange traded fund. So it's just the structure of how it is. As you say, I talk about real estate. This product's called REITs, which stands for Real Estate Investment Trust. So you can actually you can invest in property without actually having to buy a property. I think that's pretty cool. What you do is you put money in these funds, and what they do is then take your money and buy property. They buy not just houses, but also like offices, land, and it's from all over the world. So you can also invest in gold. That's not available in Revolut, unfortunately, but it's also crypto and all that stuff. I say I'm not recommending that you invest into any of these things just for disclaimer, but I'm just giving you examples of very diversified funds in these different asset classes. Yeah.
I believe Revolut has just launched gold and silver.
Oh, have they? Okay, great.
Literally in the last week.
Oh, perfect. So there you go. You can look it up there. And let's see what else. Yeah, there you go. So that's all really for now. If you want to get in touch with me, you can do it here. I actually have a newsletter called City Chat. We love chat. So I really write about all this stuff, personal finance, investing, side hustles, all that stuff. So if you're interested in that, you can subscribe to this weekly newsletter. And those are my socials. So that's it, really. Any questions? Yeah.
Thank you, Sergio. That was great.
Thank you.
I know you have a massive background with Goldman Sachs and so on, but I just wanted to ask you, how did you start?
How did I start?
And then whenever
in finance.
investing more than in finance.
Sure, investing. Well, I was living and breathing it when I was, working there. And yeah, I did the CFA. It's like you really learn about. Basically, it's a postgraduate degree on investing, and you can see once it starts sinking in, and I think you start fighting your immediate gratification kind of instincts as a human, that you realize that you can actually make money over the long term by investing. So I just got started by I started doing just single stocks, which was maybe not the best idea. I was lucky, some of them went pretty well, but some of them didn't. And it was kind of like a natural progression. But I wish, back then, there wasn't really a lot of this information that there is around now. In fact, actually, I have some bonus resources here that you might want to check out. This book called Unshakable. It says it's by Tony Robbins, which I know some people think he's a bit cringe, but the book was actually written by someone else called Peter Mallouk. He's a really good investor, and it's kind of covers of what I've spoken about. You can actually find the summary on YouTube, so you don't even have to buy it, I think. That's kind of if that answers your question.
Yeah, thank you.
Yeah. I'll just quickly, I'll take a chance to just talk about these things. If you want to go beyond maybe just investing, and you can also check out these books How to Get Rich. Again, very aggressive title, I guess, but it was written by this guy called Felix Dennis. He founded Maxim magazine, which maybe some of you guys from the early 2000s might remember. It's a really good book on how actually to build a huge empire. The 4-Hour Work Week, great title as well. Really good book about entrepreneurship, but just also lifestyle. It's not just all about money. The Lean Startup, great book as well if you want to start a business in general, just to validate your ideas, not waste your time and money building something no one wants. And The Magic of Thinking Big, again, very cheesy name. I like cheesy name books, but yeah, it's a perfect. It's a great book just to kind of think about all these how you can grow in general. So yeah, and then the other useful content I recommend is Peter Maluk, really good kind of approachable guy on investing, and yeah, there's other podcasts I listen to. There's a really good course. I think it's only $20 called Monthly 1K. It's for people who want to start a business, a side hustle, let's say, and just don't want to don't have a lot of capital and just want to get started with becoming an entrepreneur. So, and again, I'm not getting paid for any of this stuff, so just the things I like. So yeah. Any other question?
I have some.
Sure.
So if I'm not mistaken, every time when I'm buying some shares in a Revolut app, for instance, I need to pay some commission, a fee, and then if I need to sell it, also some fee. And in some countries, if I have a profit, then I need to pay some taxes from this profit. And how to calculate what is the minimum amount I need to put per share that I can cover these fees for at least buying this share?
Great question. I mean, most of the time they charge you a percentage of what you're trading, so it's not really like you have to pay the fee separately. So it's just taken from from the amount that you're trading. Most of this, I think, if you have Revolut Premium, they might not charge commission at all. It's very common, actually. I think Robinhood in the US started this; like they just don't charge any commission. So I would recommend just check the fine print. Unfortunately, I don't really know exactly if Revolut charges, because I use the interactive brokers mostly. That's more advanced. But it's just an easy way to do it. But that's a great question. You should always be thinking about that, like, where am I leaking money? And this adds up. And tax-wise, the beauty about Malta is that if you're not Maltese, again, I'm not giving tax advice, please don't sue me. But capital gains, for example, are tax exempt if you don't remit them, in general, so if you have a stock that you sell, that it's a US company, let's say, and you make a capital gain, you normally don't have to pay tax on that. So as a Maltese tax resident. So.
Oh, that's very great. And for instance, if you're talking about the mobile app which you are using now, and what is the name again?
Interactive brokers.
Interactive brokers, yeah. And if I want to buy some shares, what is the just to understand numbers, 200 euros minimum or 500 minimum just to all these fees?
Yes, I think that I may be wrong, but I think there is to fund your account. I think you need about it might be €1,000 or something like that, and then the fees will just be a percentage of your trade. Although I think there's a minimum, I think for some trades that might be like $1 or something like that. So it's not really a huge amount, and it'll come directly from what once you put in the trade order. So you don't really have to worry about having money on the side to pay for those fees. Yeah.
So it actually doesn't matter if it's small amount or big amount. I'm not losing anything. So it's not that if I put a bigger amount, then it will be better in terms of fees.
No. Normally, they charge like either a minimum fee or like a commission, or a percentage commission, and sometimes no commission at all. And normally, like fees have been going down actually a lot because there's a lot of competition now. Robinhood, I don't know, Vanguard, all these companies, like they have been like making it very competitive. So brokers used to charge $20 for a trade or something like that, and now like most of them like don't charge anything. And the way they make money is a little bit cheeky as well, because they will sometimes like they won't charge a commission, but they maybe not give you I don't know, maybe best execution sometimes. I mean, I'm not accusing anyone of doing this, but like they might actually be feeding liquidity for let's say high-speed traders and stuff like that. So again, I'm not an expert in that, but like it's really it's just kind of like the industry's gone that way. Like commissions are really low now. So
I believe eToro have zero fees, but they have a withdrawal fee.
yes, and I think you can only trade in dollars.
$5
So
fee or something to withdraw.
yes.
But to trade is like zero.
Yeah, exactly.
Yeah, so when you sort of basically, what you have to be also careful is the spreads. So when you buy and sell, so let's say if it's 100 and 101 in the market, so that $1 difference is it's what, let's say if you buy something now and you sell it next second, you lose $1.
I've been investing for 10 years, 40 years.
No, but what I mean is that sometimes the brokers, what they do is, if the spread is 100 and 101, buying and selling, they sometimes increase it. They will make it 99 and 102. And then they will say, hey, there is no cost for you. But they're building that cost in that. So, I mean, you're right to actually look at the fine print and see, and maybe even compare the brokers sometimes. Yes, either has less.
Okay.
All right.
More questions? Okay, great. Thank you very much, guys.
Yes. So everyone be like Chad. Okay, so because I gave it away earlier, I'm going to now get the Charlie Munger of Malta, who is the other almost 100-year-old person in that photo, to talk about how to invest like Warren Buffett. And if I can find your... I think it's this one, no? Oh, we have to... Maybe you can introduce yourself and I can move this.
Sure. So, good evening, everybody. Thank you all for joining us. Thank you, Sergio. It was a very good introduction about why to invest and the basics of starting to invest. So now during this part of the presentation, we'll go a little bit further into value investing, which Warren Buffett is, let's say, the most famous. Let's go a little bit. The most famous investor. Okay, now you got a preview of what we're going to talk about. The first question is, so there are basically two schools of investing. There is value investing and there is growth investing. So who can tell me a little bit about those two different approaches to investing?
Press the button. No one's. Okay, that's it.
Anybody?
Try now.
Value.
Try now. Press the other one. Yeah.
Yes.
With value, you're trying to sort of pick a stock that is currently undervalued by the market, like intrinsic value or book value, or etc. And growth, you are maybe looking at something that will grow over time because you see the potential of the business model.
Yeah, very good. Anyone else? Any other ideas? Well, that covers most of the definition. So basically, in a nutshell, when we are doing value investing, we are looking for an opportunity that is currently priced below its intrinsic value, so what it is actually worth. So we believe that the company is worth more than it is currently being priced in the stock market. Whereas with growth investing, you are looking for a company that you believe over the longer term has an above average growth potential. So in terms of their sales, in terms of their profits, that over the longer run, they will grow more quickly than average. So when it comes to value investing, value companies tend to pay out higher dividends, and this is because they tend to be the more stable companies that have already reached a particular level where they have stable cash generation and therefore can return this to shareholders. Whereas with growth companies, since they're still in the growth phase, they would usually pay out low or sometimes even no dividends because they will be reinvesting all the profits that they make back into the business to fund the future growth. So one very important metric we're going to look at is valuation multiples. So we'll cover what these are on the next slides. But just to keep in mind for now, value stocks are characterized by low valuation multiples. So we are looking for companies with low valuation multiples in our search for value stocks. And it's the opposite for growth stocks. So, I was told to keep this part short, but the price to earnings ratio is one of these valuation multiples. So we're going to go through this example quickly. So if we look at company ABC, so the revenue or the sales is 100 million, and then the net profit that they make is 20 million. Now the number of shares in circulation of this company, so these are the shares that one can buy or sell on the stock exchange, is 50 million. So now we want to calculate the earnings per share. So what we do is we get the net profit and we divide it by the number of shares. So we have an earnings per share of 40 cents. Now what does this mean? If I own one share of this company, technically I'm entitled to 40 cents of the net profit of 20 million at the end of the year. Now, if the share price is 4, meaning the price you see in the market, 50 million times 4 euros per share leads to a market cap of 200 million. So this is the value that the market is giving to this company. So the market currently thinks that this company is worth 200 million. So to calculate the price to earnings ratio, there are two methods. We can either take the market cap and divide it by the net profit. So the 200 million, what the company is worth according to the market, divided by the 20 million profit that it makes, and we get a PE of 10. This is the way to calculate it if you have the total figures. If you have the per share figures, you could take the share price divided by the earnings per share, and you also get 10. So it's just two ways to calculate the same number. Now, if we look at company XYZ, so all the figures in the first 4 rows are the same. However, the share price here is 8. So, in that case, 50 million shares times 8 euros per share means a market cap of 400 million, and therefore the market thinks that this company is worth 400 million. So who can tell me what the price to earnings ratio of company XYZ is? 20. Yeah, very good. So the price to earnings ratio of this company is 20. And in this case, what we would do is so always disclaimer, it's important that these two companies are in the same industry so that you can compare these valuation multiples like the price to earnings. But if they are in the same industry and they are comparable, then generally speaking, the company with the lower price to earnings ratio has more value. And if you just think of it very conceptually, you are buying a company that's earning the same net profit for a lower price. So you are getting more value compared to the price that the market is giving this company at the moment. Did everyone understand this point? Any questions so far? No. Okay, so regarding the price to earnings ratio, so this is one of the most commonly used multiples. However, one thing to keep in mind is that the net profit, since it's an accounting figure, it can be, let's say, manipulated in some ways, depending on which accounting methods are used and what kind of accounting policies the company has. So that's one thing to be careful of. And also, as we said before, the company should be in a similar industry to be able to compare this number. Or what you can do is, if company ABC right now has a PE of 10, you can look at what the PE was in the past, and if it was 15 in the past, then it might be a good time now to buy it because it's currently being valued in a low way. And the other point to mention is that this can only be used if the net profit is positive. So if the company is loss-making, then this is not a multiple to be using. So similarly, we have price to sales and price to book. So the price to sales, very easily, it's the market cap divided by the revenue. And once again, the lower it is, the better value the company is. So in the first case, the price to sales is 1. In the second case, it will be 2, 600 divided by 300. So company ABC should be providing better value at the current market price. Then the price to book basically is looking at the equity in the company. So on the balance sheet of a company, so a company has its assets and has its liabilities. If you pay off all the liabilities, then what is left from the assets is your equity. So if the equity is 50 million in the first example, you're basically taking the market cap divided by this equity, and you get a price to book of 2. In the second case, the price to book is 1, so again we look for the lower one. So in this case, the second company would be more of a value company based on this metric. The price to book is also what you can use when the price to earnings, when the net profit is negative and the price to earnings cannot be used, because it's more likely that the book value is positive and therefore this ratio can be used. So these are just, let's say, just some beginning indicators of which companies could be value companies, and they should never be used in isolation, but when we look at them together, we get a pretty good idea of where the company is being valued in the market. Any questions? Okay. So here once again, the value investing is bargain hunting, buying stocks that are undervalued by the marketplace, and growth investing, finding the next big thing, buying stocks of companies that are growing fast and will appreciate in price over time. So here at the bottom, we find the key people that were, let's say, the founders of these two schools of investing. So on the value side, we start with Benjamin Graham. He is known as the father of value investing, and he was actually Warren Buffett's teacher. And he laid the ground, the foundation basically for what we now know as value investing. So Benjamin Graham and David Dodd together, they wrote a book called Security Analysis, and this is a very famous book on the principles of value investing. And then we have Warren Buffett, the main topic of today's presentation. So he is the CEO of Berkshire Hathaway, and he became one of the most well-known value investors in the world, as he gathered a wealth of over 100 billion through his value investing techniques. When it comes to growth investing, there's Phil Fisher, Thomas Rowe Price. Thomas Rowe Price is who is known as the father of growth investing, and William O'Neill. So all three of them, they basically emphasize the importance of the growth of a company when looking for a long-term investment. So the next question probably would be, which one is better, value or growth? So there are a few considerations to make here. One is that it very much depends on the particular investor. So everybody, Sergio also explained, every investor has their own needs. So what makes more sense for you really depends on your particular circumstances. So let's say, for example, if you are looking to have a monthly income from your investments, then it might make more sense to go for value stocks, which tend to have higher dividends being paid out. Whilst if perhaps you have a very long-term time horizon, you can withstand volatility, then maybe growth investing is more for you. So when it comes to which one has performed better, here we can see that basically over different periods of time, value has outperformed or growth has outperformed. So we can see in the 80s it was value, then growth for a few years, then value again. Then we got our tech bubble, where obviously growth outperformed massively in those years. And when the dot-com bubble burst, value basically had an outperformance of 10 years. So the first decade from 2000 till 2010 approximately, value was outperforming. And in the following 10 years, growth outperformed. Now, the last few years, we've seen again that value has been outperforming growth. Now, this graph can differ depending on which time periods we take, which indices we take to calculate these returns, and which geography, etc. But just the main idea is that generally there are periods where one outperforms the other. And in Warren Buffett's own words, most analysts feel they must choose between two approaches customarily thought to be in opposition, value and growth. Indeed, many investment professionals see any mixing of the two terms as a form of intellectual cross-dressing. We view that as fuzzy thinking, in which it must be confessed I myself engaged some years ago. In our opinion, the two approaches are joined at the hip. Growth is always a component in the calculation of value. constituting a variable whose importance can range from negligible to enormous and whose impact can be negative as well as positive. So, just 2 points here I would like to highlight. He says the importance of growth can range from negligible to enormous. What do you think he means there? Any ideas?
Risky.
So here the main idea is that it depends, so the importance of growth depends on which industry you're looking at. So if you're looking at a technology company, then growth might be very, very important to the progression of the value of this company. However, maybe an industrial company that's already very mature, that is growing at a stable 1 to 2% every year, maybe growth isn't as important of a factor there as is cash generation, as an example. Then he also mentions the impact of growth can be negative or positive. So just because a company is investing in growth doesn't mean that it is always profitable growth. So a company can keep on putting more and more money into the business, but if this is loss-making, then you're growing your revenue, but you're reducing your profits. So yeah, exactly. So it can be trying to create growth can also have a negative effect on the value of the company. So the lessons from Warren Buffett, there are a lot, so we tried to condense this in a couple of slides. But these would be the key ones. So never invest in a business you cannot understand. So this is one of his main principles. He doesn't invest in anything that is not simple enough for him to understand fully, be an expert on in the field. And in fact, this is how he survived through the crash after the dot-com bubble, because he was not invested in technology companies that he could not understand. And in fact, he didn't understand how to value technology companies for a long time, and it was only in 2016 that he bought Apple for the first time. So secondly, a low-cost index fund is the most sensible equity investment for the great majority of investors. So this is also what Sergio touched upon before. I mean, considering that the first point that we mentioned, that we should fully understand businesses, we should become an expert in the field, it's of course not feasible for most people who aren't doing this on a day-to-day basis. So Warren Buffett also says investing in a low-cost index fund, such as the ETFs that Sergio mentioned before, where basically we're investing in a fund that diversifies in itself, has a number of equity positions, but importantly at a low cost. That can be a very good solution for most people who don't want to spend every single day reading annual reports and financial statements. So if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. This was also on Bruce's opening slide. So the aim here is always long-term ideas. So we need to have the perspective of, if we're buying shares in a company, it is as though we are owners of this business. So you do due diligence on this company as though you are going to be the business owner for the next 10 years, not just to trade it very quickly for a short-term gain. Be fearful when others are greedy, and greedy when others are fearful. Seizing opportunities does not require great intelligence, a degree in economics, or a familiarity with Wall Street jargon such as alpha and beta. What investors need instead is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. A willingness to look unimaginative for a sustained period, or even to look foolish, is also essential. So here, the main point is that there are always moments where the market is very, as we call, bullish. Everybody's very optimistic. Everybody thinks the market will go further up. And that is usually the time when valuations get pushed so high that if you start investing at that point, you are overpaying for a business, which is what we want to avoid. On the other hand, there are always those moments as well where everybody is pessimistic. It looks like the stock market is going to end. And that is the time, if you have cash available, even though there's a lot of fear in the market, that is when you should take your opportunity to invest, because you can probably buy things at a great discount. And another very important point that Warren Buffett always highlights, you should never be run by your emotions. So your investment decisions are based on clear fundamental analysis, research that you have done, and you should stick to that and not let your fears guide you as much as possible. So every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. When a downpour of that occurs, it is imperative that we rush outdoors carrying wash tubs and not teaspoons. So, Warren Buffett had held a lot of cash in 2000 and in 2008. So as soon as the market crashed, he had the firepower basically to invest when companies came down from astronomical valuations. So this is when the opportunity presents itself, you need to be ready and take it fully. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So this is again the difference between price and value that we discussed before. So you can have a great quality company, but if you overpay for it, then it's still not a great investment. So instead, we always want to emphasize finding something where we believe that the value is higher than the market price at the moment. It is insane to risk what you have and need in order to obtain what you don't need. So here what Warren Buffett is saying is that he does not believe that anybody should ever borrow to invest, because you are risking your own livelihood to try to gain, but this generally is not a good thing to do. There is simply no telling how far stocks can fall in a short period. Even if your borrowings are small and your positions are not immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary, and an unsettled mind will not make good decisions. So again, if you feel like you have all your money invested, you don't have anything extra left, and you see the market go down 20%, the most likely thing you will do is you sell at the worst possible moment. So ideally, you invest what you keep what you need, in essence, to make it through your day-to-day. What you invest is something that you feel you can leave in the stock market for the long term. Okay, so when Warren Buffett studies a company, he looks at four main aspects of the business. So the first is the business itself. As we already discussed, something simple and understandable. And as we said as well, he reads a lot, he becomes an expert in the field. So that's point number one. Consistency across economic cycles. So inevitably, the economy is going to go through upward phases and downward phases. When you find companies that have shown that they can consistently deliver no matter what part of the economic cycle we're in, those tend to be the best value companies. So what we like to do is you look at a period of the last 10 or 15 years and you see what they have done revenue-wise, profit-wise over that time. If you see, for example, in 2008 that the company was able to remain profitable, this is already a very good thing. So in a stress scenario, it was able to maintain its profits. Then management. Transparency on mistakes. So Warren Buffett says everybody makes mistakes, but the best management is the one that owns up to their mistakes and they learn from their mistakes. So being open about what went wrong. Innovation. We don't want to be mediocre and just join the herd. We want to always be pushing to keep our competitive advantages and always be the ones to be creative and move forward. So regarding dividends, so on this point, if a company can do something with the money that is going to create further value in the company in the future, then it makes sense for the company to reinvest in itself. So they don't distribute the dividends to the investors, but instead they keep the money and your share price should go up in the future. However, again, if we take this example of a mature company, a mature industrial company, if they do not have any investment initiatives where they can do that, then they should be returning this money to investors. So financial. So this is very basically low leverage companies with high profit margins. So low leverage meaning that the debt of the company is low and manageable, and high profit margins. But something I would like to add is it is not always good if you invest in companies with profit margins that are too high, because that always attracts competition. So sometimes it might even be better to have a company that's just flying under the radar rather than having an amazing profit margin. Return on equity. This is another one of those financial terms, but basically here what we're saying is when a company is making profit and it's keeping those earnings, the capital of the business is growing. So the return on equity is basically calculating the profit that they are making using that capital. So it's again an alternative metric to look at, but it's one that's prioritized by Warren Buffett. And then cash generation. So before we mentioned that accounting profits can sometimes be manipulated in some ways, cash generation is a lot harder to manipulate. You either have it or you don't, right? So this is also a very important point to look at when you are studying the financials of a company. Then the fourth point is value. So there is the moat that Buffett always talks about. So the moat basically it means that you need to find a company that has a sustainable competitive advantage over its competitors. So it is able to keep its competitors away, keep its competitors from stealing their market share, to always remain at the top of their game, basically. And discounting of future cash flows. So here, this is basically a projection of what cash flows the company is going to earn in the future. And then discounting them to today. This is again another method to calculate the value of a business. So here we have a few more wise words from Warren Buffett. If you don't find a way to make money while you sleep, you will work until you die. The most important thing to do if you find yourself in a hole is to stop digging. So this is a very important point that I would like to stress on. Once we invest in a company and suddenly it falls 50%, you might feel inclined to, let me double up and put in more money here. That's an emotional reaction, right? So very often it makes more sense to say, I'm going to cut my losses, sell it here. But all these decisions have to be made again without any emotion. So you do again another analysis at that point. If the investment case has changed, don't be afraid to take that loss and move forward. But don't feel the need to just keep on piling in more money just because an investment is not doing well. The difference between successful people and really successful people is that really successful people say no to almost everything. So another thing that he says is great investments come about maybe once every 5 years. It's not a day-to-day occurrence. And he says he made his money through those great investments once every 5 years. Then if all your other investments are doing mediocre, but you just protect your capital on the downside, so you don't make too many massive losses, then that is already a winning investment strategy. Games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. Again, trying to keep the emotions out of it and just focusing on the fundamentals. If you cannot control your emotions, you cannot control your money. We all make mistakes. If you can't make mistakes, you can't make decisions. I've made a lot of bigger mistakes myself. We don't have to be smarter than the rest. We have to be more disciplined than the rest. It's good to learn from your mistakes. It's better to learn from other people's mistakes. And this is one of the most well-known ones. Rule number 1 is never to lose money. Rule number 2 is never to forget rule number 1. So here, as we said before, it's impossible never to lose money. That's not really the point. The point is that you just protect your downside. So you're never in a position where you can lose huge amounts. Now, how do we do this? As we mentioned before, diversification, trying to find companies that are undervalued so that you have your downside risk protected. So I also wanted to give you a few numbers, and for that I went to Benjamin Graham's Investing Principles. So this was Warren Buffett's teacher. but he mentions a few ratios here and a few figures that can help you in determining what would make at what level is something a value investment. So you have the quality rating. There is the S&P earnings and dividend rating. So if this is over a B, then generally you have a good quality company that has shown a consistent track record over the years and has future potential. Financial leverage. So this is basically how much debt the company has. Now there are different ways to measure it. One way is to see how much the total debt is compared to your current assets. Your current assets are your assets that are either cash or can be converted into cash in 1 year. So your most liquid assets. So what is your debt compared to that? But you can compare it also to your liabilities, to your equity, but you should always check for a way to make sure that the business has an amount of debt on which it can easily survive, even in tough times. Liquidity, so current assets over current liabilities. So current assets, as we mentioned before, assets that are easily convertible into cash. Liabilities is the opposite. So everything you need to be paying out in the next 1 year. So when you compare these two together, you are able to see if a company can meet its short-term cash needs from its short-term cash sources. Earnings growth, positive earnings growth for the last 5 years. So this isn't just positive earnings, but actually the growth in the earnings is growing year after year after year. Price to earnings ratio, so one of the ratios we looked at the very beginning. Here he says it should be less than 9. Now I think in general it will be very difficult to find a good quality company with a PE below 9. But let's say if you find something between 10 to 12, it is still a very, very good PE ratio, but this is very industry dependent. So a PE ratio of 10 to 12 is very good in, let's say, in the industrial sector. When you have technology companies, those PEs tend to be a lot higher. So then even a PE of 20 could be a very good PE. So really depends on the industry. And as we said before, always try to compare companies with other competitors in the same industry to get an idea of where the PE should be. Price to book ratio that we also looked at before, below 1.2. So basically, if we had to take a price to book of 1, what we are saying is, when all liabilities are paid off, the assets that you have remaining are exactly the same as the market cap. So what I am paying for this share today, I have in assets of this company after all liabilities are paid off. So if you have a price to book of that is relatively low, let's say less than 1.2, again, it protects your downside, because in the worst case scenario, business goes bankrupt, and there should still be value left. And the last point is dividend yield of more than 0, basically meaning that it pays out a dividend. So very important, a value trap. Sometimes a company can look cheap, but it is because it's just a bad quality company and not because it's a bargain. So this is something to look out for. If you find a company with a PE of 2 or 3, those definitely exist, but it generally means that there are a lot of problems going on and the market doesn't believe that this company can survive. So through all the techniques that we have discussed so far, that is how you should be determining whether something is a value trap or something is a bargain. So to conclude, these are the main highlights that I hope you will take away. So always looking at the intrinsic value of a stock compared to the price that the market is giving it, understanding the business fully, consistency in the financial performance and growth of the company, investing for the long term, leaving your emotions to the side when you're investing, but focusing on the fundamental aspects, the moat, so the competitive advantage, and keeping competitors away, and integrity and accountability of the management. That's it. Thank you very much. Are there any questions?
I have one question.
beyond the financial ratios that are the hard science, this is the hard science behind investing. From your perspective, what are the I don't know 4 key parameters you would look into a company that you might be looking as a potential target for investment, and especially if it is a technology-based company, what are the 4 key elements that would catch your eye when reading a prospectus or when doing some form of an assessment?
So I would always say, again, it comes down to reading a lot, but if you read the annual report of a company, you will learn everything there is to know about the company in the easiest way. So generally the start of any analysis that I would do is always to first go through the entire annual report, and that will give you all the questions you may have, all the points to delve into further, because just all the information is there. Then on top of that, there's always a lot of broker research available. Now, I wouldn't follow that. If you follow that, you will be following the herd, so it doesn't necessarily give you a very good investment idea. But again, those are ways to figure out what analysts that are spending, most of their time of the week studying a company, what they are looking at. So maybe something that you might have missed, they could highlight there. So it's very case by case. I don't think I can give you a very concise answer, but I would just say you have to study the company to then know which are the areas to look at. And then through experience, you would possibly even know before reading the annual report, for this kind of company, I need to look further into this.
Thank you.
Anyone else?
Hi. Thank you for a great presentation. I had a question about your opinion or your idea of why Warren Buffett invested into Japan, because I believe that has never been done before by him, correct? And if it had anything to do with the Japanese interest rate policy. Thank you.
I don't know in particular about his investment in Japan, so I can't give an answer on this. Don't know if anybody else knows about this in particular.
Everybody, but I don't really know because.
So we'll research it and get back to you.
What do you think will need to change for value to come back into fashion?
Very generally, value already outperforms when interest rates are going up, and growth tends to outperform when interest rates are down. So I think just in general, the revamp of the value stocks that we've seen in the last few years has mostly been because of the rising interest rate environment. So I think that is already a very good push for value to be in fashion.
It hasn't happened really though, has it, this year?
Since the graph that I showed stopped at 2020, I looked up graphs to see how it progressed after that, but they do show that value has outperformed growth in the last few years, especially as the interest rates have started to go up.
All right, thank you.
Yeah. Oh,
Sorry, did you want to ask a question?
Yeah, maybe just because
Go on.
you bring back that chart of the value and growth.
1 second, you'll have to move back. 1 second.
That's impossible.
Try now.
Because it starts in 2008, right? When the great financial crisis is kind of when it.
Yeah.
So when all the let's say central bank programs and everything started, kind of went the other way. So now we're at the end of that, so we've almost expected it to go the other way.
Yeah, exactly.
And go vice versa again if it goes.
Exactly. That essentially also leads to the changes in the interest rate. So all these things are interconnected.
All
So
right.
in a way that there's no real kind of, you can follow the trend almost.
No, this is not to say that because value has been outperforming the last few years that means that value is going to outperform, but it's just to show that.
No, I mean it correlates with what the banks do. So in a way, value or growth is kind of following interest rates and following
Exactly.
central banks and the whole thing.
Exactly. Yeah.
Okay, thank you very much, Charlie Munger of Malta. Thank you, Sharon. Thank you. So I mean, this I think Sergio kind of got you guys into this expectation that you would put $1 and it'd be worth $1 million after 100, 200 years. But as you know, as they explain later on, it's a lot of research. And I think for a lot of people who are newbies, these are a lot of new financial terms. So please don't give up. It's not easy. If it was easy, everyone would be rich and retire early. But if you keep coming to these sessions, if you keep talking, if you keep reading, you will definitely learn more. So thank you very much for coming. We will probably take a break for summer because I think most people want to be on the beach. Unless we see a lot of interest. So let us know if you want to do another session next month and continue on during summer, or we start after summer. So can we stay here for a little bit more?
Of course.
So, yeah, so we can stay here a little bit more if you want to get some drinks, support the place, wonderful place Soho has given us here for our event. So thank you. Maybe claps for Soho. Yeah. Thank you guys for coming in.